Well, it's good to see everyone here today. I'm very excited to introduce to you, and some of you may already know him, Joel Posen. Joel is a price and volume trader. He was trained by Richard May himself, and comes with just a wealth of experience. And he's here today to impart to us and teach us a little bit more about trading with price and volume. Joel trades mainly the S&P, but he'll show us today how this can be applied to really any time frame in any market. It just, the market makers are very consistent in telegraphing what they're about to do over and over and over once you understand how to read price and volume. And I'm going to keep the introduction short because we're here today to learn from Joel. We're here today to watch the chart and see what's happening and ask questions. So I'm going to turn it straight over to Joel, let him get started, and then we'll go from there. So Joel, if you're on, go ahead and let's hear your lovely voice.
Welcome, traders, and thank you for joining me today. Because you're here, I can be of service to you. By the time the webinar is over, you're going to have forgotten more about trading than most people will ever know. And before we go to the live markets, I have some promises to keep. You're how to buy wholesale and sell retail just like the pros do. They're the ones who take the most, and I emphasize take the most out of the markets. That enables them to use the tightest stops in trading, which thereby provides them a remarkable risk-reward ratio. For those of you that are into semantics, it's known as asymmetrical risk. Very little risk and a lot of reward. And you're looking at a 5-minute chart of the Forex. I put this up here because a lot of you guys trade the Forex. I've also told you I'm going to teach you how to determine margin and to make 50% in the market of your choice. So I got to teach you that first. So we're going to go through some slides. Then we're going to look at real charts, followed by what it entails to work with me. Then we're going to take questions and answers. So I suggest on the paper you have in front of you, you draw a line down the middle, using 1/2 to take notes, which is, as I say, going to enable you to forget more about trading than most people will ever know. And on the other side of your paper, write down the questions that you have. And hopefully all of you have prepared by reading the Nay Guide and plan on being here for about 90 minutes. All right, so here was a beautiful sell signal in this pound dollar. You'll know why later on. I tell you, you can use the tightest stops in trading. And Brian's seen me over several years. And the first time we did this with Forex, I challenged people, tell me what stops you use to trade Forex. And it was really a setup because I knew what was going to happen. And it did happen. We got answers between 20 and 30 pips, which comes to $200 to $300. If you got to use a $200 to $300 stop to trade Forex, you shouldn't be trading Forex. You shouldn't be trading at all. This here is a $50 stop. Would have worked. On that webinar with Brian, I said you should be able to trade Forex with a 10 pip stop, which is $100. And truly, you should be able to trade it with a 8 pip stop. This was a 50 pip stop here, and I'll put it here. Those of you that are familiar with Forex here, you can see that where the bar opened and a 3 pip and 1/10 of a pip worked on that. And this went down for 51 pips. This went down for 130 pips at $10 a pip. In this case, you could have used a $40 stop. It's $1,300. on $40. So you've seen this. This is today. This is live. The market's ticking. You can see the countdown on a 5-minute chart here. This really happened today. There was another opportunity up in here to sell. All right, so you're seeing it. It is for real. Later on, I'll show you here the euro versus the dollar here. And here was a $540 move. And I'll explain why this was a buy down here and why there was weakness here. But let's first get to, and I'm here to teach you. I'm here for substance. I'm not here for appearance. If I was here for appearance, this would be expanded and there'd be all kinds of bells and whistles when I went through each one of the slides. Well, if I did that, then when I went to break away from here to get you into the live market, then when I came back here, we'd have to start all over again, and then I'd have to move it around, and it just doesn't work. And maybe other people have better skills at that than I do. So let's just concentrate on the substance here and forget about the appearance. So you've all seen this. You can go to the website, besttradingstrategiesrevealed.com. You can read more about this. Most importantly here, don't trade with money you can't afford to lose. If you've got that attitude, you're going to lose, because that's what you're holding in mind, loss. So if it's mortgage money or medical insurance money, it ain't going to happen, because your mindset isn't right. And mindset is what separates winners from losers. You can give the best trading system to the worst trader and they'll lose money, and you can give the worst trading system to the best trader and they'll make money. And it's all because of mindset. It's something I've never seen anybody tell you when giving the disclaimer, always trade with these stop losses on the floor. And that's the first thing I showed you here about the $50 stop here. And here another $50 stop worked on both of them. And I can't make this up. So always trade with stops, know what your loss is. And that's another thing about mindset. Fact of the matter is that amateurs think making money first. That's not how pros think. Pros think protection first, preservation of capital so that they can trade. If you lose 50% of your account, you've got to make 100% on your money, which most people will never do. You will find out how to do that, and it's not that difficult once you know how to trade. As my mentor Richard Ney said, it's a shame that you don't make money, because call them specialists, call them market makers, call them professionals, insiders, whatever you want to call them. They make money so easily. As Ney said, it's a shame that you don't, but you can. And let's get into it right now. So you've come here to create an income solution. With a price and volume, you can trade any market in any time frame. It's universal. Price and volume has worked for me for 25 years. It was 1990 that Ney and I worked together, and nobody else is teaching Ney. And if they did, they hadn't been trained by Ney. I could pick up the phone and I could get him to talk to me. Did I take advantage of it? No. About every 6 months I talked to him and thanked him for what he provided me, the wisdom, the knowledge, the truth about trading, about markets. Okay, so will you be able to maintain your lifetime in retirement? Probably not. So again, you're here because you want to create income. And there's no greater place to do so for the masses. This is the problem. You got the people on Fraud Street. They're fee factories. You have to realize the difference between 1% and 3% is the difference. Take this as an example and apply it to any number you want. Assuming that you had $1 million in your retirement account or in your trading account, any account, doesn't matter. If you're paying 3% fees versus 1% fees, again, just take this as a generalization. The difference in retirement is going to be $300,000 to $1 million. By paying 1% fees, you're going to have $1 million. By paying 3% fees over time, not having that money to grow, you're going to end up with $300,000. Then you got the people over here in Washington that I like to call Clown Street, and they got high taxes. So everybody wants your money. The middle class here, their money is attacked. And it's been attacked for the last 70 years. And it ain't going to stop, and it ain't going to get any better. So you need to know how to protect yourself first, and then how to grow your money. So the question is, are you willing to do something different to have something different? It's a decision. You've got to make a decision. Price and volume are the only true leading indicators. So, question, do you want to trade with foresight rather than hindsight? With price and volume, you anticipate where price is going to go. So, everybody tells you, follow the money. Well, but they don't tell you how to follow the money. Price and volume tells you how to follow the money. If you follow the money, you're going to make money, and that's going to give you joy, and this is what your retirement is going to look like. You will retire on time and on budget. So you're about to discover a simple, proven method. Like I said, price and volume has worked for 150 years, and is going to work tomorrow and 100 years from now. You could teach this to your grandchildren. It's proven, it's profitable, it's low risk, it's practical, it's easy to understand, and it gives you amazing wealth building opportunities. Price and volume, foresight, you can spot the insider's actions. They leave their tracks on a price and volume chart. They cannot hide them. That's money. Money votes. Then you duplicate them. That's what Nate was getting at when he said he wanted you to piggyback those who take the most out of the market. He was a little more politically correct. He said make the most. But they're really taking it, and they're taking it from the amateurs. So you're going to discover exactly how the market works and why it's set up this way. It's set up by larcenists to separate as much money from as many people as possible in the least amount of time. And they're very good at doing it. So, price and volume is how to take control of your financial future. Nobody's going to protect your money or look after you the way that you do. The fee factories are after your money. Now, here are 4 steps to financial independence. So we're not going to get into most of this stuff today. I just want to put it out on the table for you. You're going to develop trading skills to the point where they justify forming a corporate entity. In other words, it's financially feasible to do so, and that's going to increase your cash flow, and it's going to increase the money you have to trade. That's one of the secrets. By becoming a corporation, gives you benefits. Wealthy people know this. It's part of how they become wealthy, stay wealthy. Then you can establish a defined benefit pension plan, not one of these 401ks where you can put away a ton of money, hundreds of thousands of dollars a year, and they're tax deductible and they're tax sheltered, which means your money grows untaxed for the time that it's in the pension plan. This also enables you to protect your assets, which is another story, and then you're able to compound the money. Einstein called compound interest the greatest invention of mankind. Then you get to retire and live the life you love. You get to live the life you love now because you're making money, big money, as you're going to see. Here's the money growing power, the miracle of compound interest. So, talk about here 50% a month, cash on cash. So we start with $10,000. Well, if we make 50% the first month, the next month we're coming to the market with $15,000. Well, 50% on that gives you $22,500. After 12 months, your $10,000 in round numbers has become $1.3 million. Now the fun really begins, because the next month when you go to the market with $1.3 million, you're going to have 1.95 million that next month, and we'll make that 2 million, and which means the next month you're going to make another $1 million, $1.5 million, excuse me. You have in 14 months, 10,000 can grow to $4.5 million. Get your attention? This is the miracle of compounding interest. This is what the wealthy know. This is quote unquote the secret to making money. Trading is simple. People make it complex. If you're looking for complex, you're never going to see simple. Price and volume more than levels the playing field. It gives you an insider advantage, not an illegitimate criminal advantage like the people on Front Street and Clown Street have. This gives you a legitimate advantage. So is trading really that difficult? Hell no. This is amateur on Payne Street, and we want you to become a professional on Pleasure Island. And the difference is what professionals know. So the secret is to want what the market wants. What a novel concept. And that frees you up. You don't have control of the markets, and if you think you do, you shouldn't be here. The market's going to do what it needs to do, and what it needs to do is meet the inventory objectives of professionals. So you've got to learn to read charts like a professional. And again, price and volume are the only true leading indicators. So again, you're going to trade with foresight, anticipating where price will go. Price and volume method works because that's how the market was designed to work. So again, a decision. You have a choice. You can be an amateur and live in pain and struggle, or you can become a professional, know what a professional does, and employ it, apply it. So when you know how to read a chart, you'll trade like a Wall Street professional, and you will create the wealth and lifestyle you deserve. You'll consistently take money out of the market, you'll dramatically improve your trading results, and you're going to achieve the income and retirement goals before you ever thought possible. Go back to that thing about compound interest. It's been proven. That's mathematics. Mathematics don't fail. So it ain't me blowing steam up your butt. That's the truth. It's unequivocal. Run the numbers. So, as well as you're going to make sound professional trading decisions, and you can benefit when the market goes up or when it goes down. And that's the beauty of the markets. Very few places can you make money when things are falling. But in the market you can, and you'll make more money when the market's falling than you will when it goes up, because it falls faster, about 3 times faster than it rises. That enables you to take control of your financial future, and you're going to stop being a victim of what you don't know. So back to the difference between amateurs and professionals is what professionals know. And it's because of what you don't know that you've been struggling and why you're losing money. Here is a fellow who came to me back in June of 2013. And this is when Brian and I started together, and this is someone that Brian brought to me. So here's his email. All I've got to say is, wow, this is amazing. For years he struggled to pull a meager 50 pips out of the market in a single month. In the last 3 days he pulled out 413 pips, and these are his trades. $10 times 413 is $4,130 bucks. And I'm going to teach you how to trade this on $4,000 margin. That means in 3 days he made 100% of his money. This is his email. And we can forget about his affirmation, and his name is Mark. And can he continue doing this? Well, here's his trades. This is his actual execution. Here it is. 6-7 months later, in 2 days, he's trading size. Look, 33 contracts here. Comes to 672 pips, or $6,720 in profit. Just thought I'd share this week's trades. They're going to pay for his moving expenses and then some. He was transferring locations, changing jobs at the time. So can it be done? Yes, it can be done. And this guy did it in no time because he signed up for the course on Friday. He went through the videos, and the following Wednesday he started trading. And that's when he made that $4,130. And here he is 7 months later, making money, trading Forex, and real money. And again, he could trade this for $4,000, so he made over 150% of his money in 2 trades. Anybody tells you trading is any more complex than this, they're lying to you. Tell them to take a hike. Tell them to get out of here. They're not your friend. They're not serving you. They're lying to you. What happens is professionals accumulate. They accumulate inventory at wholesale when prices are low down here. Once they accumulate the inventory that they want, they then move prices up. So here's a tip from Nay. It is not, contrary to popular misconception, it is not buying by amateurs that causes prices to rise. It's rising prices by professionals who have control of the market that causes buying by amateurs. And amateurs love to do breakout trades, and it's a very profitable maneuver for professionals, and I'm going to show that to you when we get to the live market. Yesterday in the S&P, I stopped counting when 8 breakout trades failed. Amateurs want a sure thing. So what do? They let price rise, and then when price is up here and professionals have no more inventory, they've distributed their inventory. The only way they can meet the demand that they created by rising prices is to short sell. And when the short selling gets done, their inventory objective is to drop prices. So it's not selling by amateurs that causes prices to fall. It's falling prices by professionals that cause the price to fall, which then causes them to cover their shorts, and the falling prices cause amateurs to sell. And pros are reaccumulating inventory there. When amateurs are buying, somebody's selling, and when amateurs are selling, somebody's buying, and that's the insider, that's the pro. This is exactly what goes on all day, every day, on every chart, in every time frame, period. There's nothing more to it. This pattern recognition. This is the second thing they taught me. The first thing was that markets are manipulated. The second was pattern recognition. So when these elephants, which are the pros, the insiders, the market makers, when they walk across your front lawn, they leave footprints, and those footprints are on price and volume charts. So the markets are rigged, and it's a great thing because they leave those footprints for you to follow. Just like you saw on the Forex today, that enabled someone to make $1,300 on 4,000 margin. Now the jerks out there are going to tell you, trade your Forex on $500 margin. Well, that goes beyond greed. That's just plain stupid. But that's what the industry's all about. They're fee factories. They want your money, and they tell you the things that are going to hurt you, not help you, because they have a vested interest in your failing. So here are the rules of engagement. This is all you ever need to know about trading. If you're not writing this down, you're not serious about making money. The first thing you need to do is determine the trend. This is the reason why most people fail. Either they can't determine the trend, or they can't align themselves with it. Amateurs always want unfair advantage, so they're always trying to sneakily do something here and there. It's not the way you make money. So, in an uptrend, when prices are going up, you buy on an oversold bar of strength at logical support. The market's a mirror. One side is equal to the other. People are going to tell you, oh, short selling is different than buying, and buying is different than short selling. Nonsense. It's all the same thing. That's why in a downtrend you sell an overbought wheat bar at logical resistance. This is how pros buy at wholesale and sell at retail. So I've now fulfilled my promise to you. And this is how simple it is. And some of you have spent 10 and 15 years trying to figure this out. And there's guys that have registered for this webinar that have been tracking me for over 10 years. They started with me when I was teaching day traders a course for $5,000, 14 90-minute sessions in the live market, along with a 2 to 3 hour acclimation session on a Saturday. These guys ain't making money yet because they don't want to believe this. They haven't made a decision to be profitable. The principles are always the same. The only thing changes are the disguises. And they like to call it about the alibi du jour. And they're always telling you this, they're telling you that. You know, last week when the NASDAQ, after 15 years, made a new high, finally, the people on CNBC were pounding the table. Sell the farm, hawk your jewels, borrow money, do whatever you got, get your money into the market. Well, we've all seen what's happened after that. So if you're listening to the news, the rumors, the tips, the analyst forecast, shame on you. Understand the real underlying mechanics that move the market instead. These guys at CNBC, they're corporate shills. They get paid to influence you to lose your money. You don't need that. All you need is a price and volume chart. Get real. Here's the price and volume in action. So now I got to teach you the principles here so we can apply them to the live market. This is a simple chart. This price and volume. So what are we seeing over here? We got an up bar. Well, this bar didn't exactly close on its high, but it closed above the middle of the bar, so that could be some form of strength, but it's kind of telling me maybe it's a little weak, but we need to find out. Well, the next bar here is a bar of no demand. That's what these dots are about. And by the way, blue bars are up bars and red bars are down bars, meaning blue bars closed higher than the previous bar and red bars closed lower than the previous bar. Contrary to popular misconception, people will say, oh, a bar that closes higher than it opens is an up bar, and a bar that closes lower than it opens is a down bar. Well, that's not how price and volume work. All right, so what do we see here? That's potential weakness. These no demand dots are telling you that pros do not have an interest in taking prices up. Prices are moving up here because amateurs want to buy here. And what is happening? This is distribution going on along here. They are filling the orders of the amateurs who are buying by selling short. This is a weak bar. Look, price came off the high, closed below the middle of the bar. That is not strong. And it did it on increasing volume to the previous bar. So that's not strong. Then you got two more bars closing off their high. This one almost closing on its low. And again, there's no demand by professionals. This here is telling you, if you want to make money, you have to look to find a way to short the market. Now, is this not right up here a logical place of resistance looking at price? Of course it is. It's a rhetorical question I'm asking you. But we come over here. Look at how price is falling, and it took out the low here. So here's an up bar. Got up here to where the resistance was and closed off of its high, and it did it on increasing volume. What does this tell you? It tells you logically that professionals were selling on this bar. Imagine that. What a novel concept. That's what price and volume told you. There's no other indicators on this chart. There's no moving averages, there's no CCIs, MACD, stochastics, RSIs. Just read the bars. That's all you got to do. So here you got weakness here. You sell here. Look how tight your stop could have been. And the market fell. Just like it said right here. It told you they were going to drop prices. They might as well have sent a letter or a messenger to your door and said, if you want to make money, sell this market. Pattern recognition. They can't hide it on a price and volume chart. They can do it on the dome, but they can't do it in price and volume. This is obviously a Forex trade here, and that's all you need to know. So here's price and volume basics. Again, I'm fulfilling my promise. I told you I would teach you how to do this so you can apply it in the real market here. Here's contrary popular misconception. And they taught me this. High volume generally is not a continuation signal. High volume usually is a reversal signal. And you see it right here. And this is a 3-minute chart of the S&P 500 futures. These black lines are order flow lines. Money never forgets. It's an art, it's a science. They become natural points of support and resistance. The market came down here to where there was natural support. So we look at this bar here. It closed well off of its low. And look, they took out the previous low here. As I told you, it's a profitable move for them. The amateurs are selling where my pointer is, because they want to be in an assured thing. They won't sell up here where pros are selling, where they should have sold, or up here where they should have sold. No, they got to sell here because they want an advantage. They want a sure thing. If it goes through here, it's going to go lower. Well, they fulfilled their promise. Prices got filled here, and immediately professionals raped, pillaged, and burned the entire village. Destroyed these people. This is a bar of strength. It closed well off its low. Logic dictates what happened here. Volume came in. Whose volume is that? It wasn't amateurs buying. It had to be professionals buying on this bar. No ifs, ands, or buts about it. They were buying. And here is momentum with the CCI, and it's showing you a market that is oversold. Back to the rules. If you're going to buy, you want to buy when the market is oversold, not when it's overbought. So, we come back up here. We come back down here. Now, here again is a strong bar. Apply the rule here. This is even better because it closed more than above the middle of the bar. It closed near the high of the bar. And again, you had increasing volume. So it had to be professionals buying. And where did they buy? They bought at a logical place of support, consistency. Everything I told you would be consistent. They bought here at this logical place of support. The bar opened here at 2,095.50. So this is recent. This happened just the other day. Tightest stops in trading. Open of the bar was the low of the bar. Price found support on an order flow level. So there you see it here. All you needed was a $12.50 stop. Now, I don't teach you to trade that way. You need a bigger stop than that. But once again, the tightest stops, the best risk-reward ratio. And look, up here, price is oversold. So I told you, if the market is in an uptrend, and this told you to anticipate higher prices, and this is the most consistent trade you will ever find in trading. It's called the second wave. By me, it's called the second wave. This is the pattern that you look for to make money. Can you buy here? Yeah, if you're skilled enough, you can, but you don't need to. You can buy here. So we're buying a bar of strength at logical support where the market is oversold. That's it. All the rules. All these years you guys and girls have spent listening to all this nonsense and all these encyclopedias of how to trade. This is all it's about. So again, you didn't need any stop here. And the high over here was 2,001.25. That's 5.75 at $50 per point from a permission to buy. Make it 5. It's $250. I'm going to teach you how to trade this on $4,000 margin. So you know you made over 2.5% on this one trade alone. Okay, let's move on. Price and volume are leading indicators. Here you see the same pattern. Here's that bar of strength. What do we got here? This is a 3-minute, S&P continuous contract, another day. Here, look, we're different price, another day. Same thing, increasing volume. Here, we come out here, buy at the open of the low of the bar. Once again, the tightest stops, you didn't need a stop other than one tick. And boom, 7.75 points here. And this is a true day run into the close. You can see they taught me how professionals love to sneak. He called it the sneaking up and sneaking down process. And this is a trade that you can count on 40% of the times. Professionals are going to run prices into the close of the market. Not many people know that. Like I told you, you're going to have forgotten more about trading when we're done than most people will ever know. So here's your strategy to make 50% a month. S&P is $50 a point. So we're talking about risking $80. How did I get $80? $75 for a point and a half and $5 for commission. Now that's 2% of $4,000, so your margin should be $4,000 if you're a sane person. You're not listening to your brokers on Fraud Street. Oh yes, $500 you can trade one S&P contract. You're going to go broke in a hurry. And they're going to make you trade your whole account. So if you got $20,000 in there, they're going to tell you trade 40 contracts. And you know you're going to need is a couple losses, and your $20,000 is gone. You know, really, you shouldn't risk more than 1% on a trade, but because of price and volume, it gives you a little bit of leverage, and therefore you can risk 2% on a trade. And again, these are the tightest stops in trading, and there's your asymmetrical risk. There's 20 average trading days a month, so if you make 2 points a day, $100 times 20, that's $2,000 that you're going to make. And if you got $4,000 margin, that's your 50% cash on cash, and you can apply it. Same thing, if you're going to use, there's no commissions in Forex, so if you're going to use an 8-pip stop, $80, you're going to use $4,000 margin. So you apply this formula to any market that you want to trade. Determine what you're going to risk. Make that 2% of whatever that becomes. You know, if you're risking $100, then you're talking about $5,000 margin. You're all good with math, so you understand what I just said to you. It's that simple, that straightforward. So, here. I teach people that you don't hesitate. When the bar closes and you have a chance to take a trade, you take a trade. And this was done on the 5th. And you can see I'm in Santa Monica, so I'm on the West Coast. This is 7:03 in 1 second. I knew when this was happening, I knew that I had to look to find a way to buy the market. I wanted an oversold condition. I wanted a down bar. I wanted a down bar at logical support, which the moving average and this thing called a trender provided me with. I did not hesitate. Exactly when the bar closed, I pushed the button, and I got filled at a market order at 2,100, and I had a profit target of 2 points, 21.02. There's your $100 for the day. This was created by news. News creates volatility. The people at CNBC and on Front Street, oh, news is volatility. Stay away. Be frightened. News creates volatility. Volatility makes you money. The news came out at 7 o'clock. The news told me I'm not controlling the market. I want what the market wants. The market wanted to go up. The market went up, and we're going to find resistance right here at one of those order flow numbers here. So it's not do as I say, but not what I do. It's do what I do, and here it is, and this just happened 6 days ago. And that did it for 20 days in a row. You do that, and you're going to make 50% on your money and go back to that thing on compound interest, and your 10,000 is going to come $1.3 million in 1 year. And if it's in a pension plan, you ain't going to pay any taxes. So here, news creates volatility. It's your new best friend. Here, news came out here. What was this? This is FOMC. Well, all this was all screwy in here. Sorry about that. You know, again, whoops, I didn't have that up. So, anyway, here we had a down bar. oversold. Here is a strength. This is a no supply. Professionals took down here to see if amateurs were going to sell. They didn't. Consequently, when amateurs didn't sell at that point, trying to fix this and talk to you at the same time. Okay, good. We got that done. I can chew gum and walk at the same time. All right, so you wanted to buy here. Again, look at the stop you used. You didn't need a stop. This is buying wholesale, which amateurs won't do. No, amateurs want to buy up here. See, look, they took out the high right here, took out the high there to get amateurs short, and look what they did. Time and time again. If you're a breakout trader, tell Brian and me how much money you want to piss away, and we're going to help you. You give Brian and me half. I'll take 25%. Brian will take 25%, and we're going to let you keep 50% of your money. You're going to be a lot better off, and you ain't going to waste your time trading the markets here. This is a sell area. This is a bar of weakness. These are test bars. You can test price. You can test volume. It's the only test you can have in price and volume. This is a bar of weakness. Went up here, could not stay up here, closed down below close of the previous bar, etc. Weakness up here. This was a place to sell the market. And look at the divergence here. Divergence. News. These are your new best friends. Winner to the downside. Moving along. Here's the beige book. News creating. Look at the divergence on the CCIs here. Obvious bottom pattern. Profitable move taking out the previous lows by the pros. Look, they did it again. Here's that second wave. Here's your stopping volume. Here's the buy at 1139. Here, 2093.50. So this is last week or so when the beige book got announced. Using news to make yourself money. Open to the bar, open the bar, the low of the bar, the tightest stops again in trading. Here we made 4 points. There, here we're oversold. Here we've shown divergence. The market is screaming in here. You want to buy the market. Find a down bar at logical support and a bar of strength that was oversold. And voila, you got a winner for $200 a contract. You just did 2 days worth of work on that. Here's the Fed testimony. Here, a $25 stop held. Here's where the written statement was released. Here, look at the volume. Closing off its low. Everybody in unison say, pros must have been buying. Here they did. Here's your down bar, logical support, a bar of strength. Not so oversold, not always perfect. Once again, tightest stops in trading. Voila. From the entry, we'll just make it 7 points. That's $350 per $4,000. It's not quite 10%, but nonetheless, I think you get the idea here. So here's serious money. This is a daily chart of the NASDAQ. And the big NASDAQ's $100 a point. And here's your bar of strength. Increasing volume. Pros had to be buying. Look at your divergence here. Look at the stop you had to use here. Look where price went. $17,000 a contract. With the stop that you used here, what if you use the $8,000 stop? You tripled your money in 4 days. Price and volume. It worked 150 years ago. Now here's a 20% cash on cash. Here's your risking 82%. This was 17 points. Take some commission, take some slippage. $800 on 4,000 is 20%. Here's your bar of strength at support. There's your test bar. Came down, look, they took the lows out, got the amateurs short. Here we are, oversold with divergence. Voila, a straight run right from there. And a good for $800 cash on cash. One trade. Here's a Forex trade. There's $700 on. This is 70 pips. Red bars with dots on the way up were places you could buy. Here, there's that strong bar again. Look, they took the low out here. Think you guys are seeing a pattern that you're recognizing. They took it out, got amateurs short. Pros had no interest in selling. That's why that dot is there. That is a no supply dot. There was no orders on the floor anymore for them to fill. They don't want amateurs and have to sell as they're going up, so they take them out. Every red bar with a dot here on the way up was a place to buy. Now, that's pretty difficult, huh? This is original from Ney. I told you about sneaking up process and so forth. So these are the previous stations, the last half hour or 15 minutes. This is from the course with his IBM Selectric. So sharp advance at the close, part of the sneaking up process. And the next day they took prices down, which told you they wanted to take prices up. If they wanted to take prices down, they want to open prices up. And that's what he says here. If there was no big blocks were 10,000 shares at the time. Now big blocks are probably 1 million. So if there's no big blocks at the high, then the decline is part of the sneaking up process. After a brief decline the next day, it's up and away. There's your brief decline, up and away. Closing decline in the course of a sharp advance, depending on the blocks at the highs, that's the volume, could be part of the sneaking up or sneaking down process. So if there are big blocks at the high, this type of closing decline is the beginning of the sneaking down process. Page 48 from the course. This is Ney's car. That's what he wanted to do, and this is what I'm doing today. If you haven't woken up after 34 slides and what you've seen, you're dead. Who was Richard Ney? Well, of course, he was my mentor and inspiration. He was also the foremost authority on manipulation of stock prices by insiders before he died in 2004. None other than the richest man in the world, J. Paul Getty, trusted Ney with money to trade. And he first got national attention in 1962 when Time magazine cover story signaled him out as having publicly called the 1962 stock market crash. He called every subsequent crash before it happened by reading price and volume off the ticker tape, not off of the charts. Didn't have it back then. He called every subsequent crash till he died. And in 1963, he revealed a little-known congressional report by the SEC that stated insiders had control of the market and absolute control at openings and closings. I just showed you that page from the course. That's why you got these sneaking up and sneaking down process. So the game is rigged in favor of those who control the market. And this is the actual flyer I got from him. And it says wake up on his car here. How to buy and sell. Came in the mail. He buys when others people are selling, which is what I've been showing you. This is exactly what professionals do and amateurs don't do. So the markets don't move, they move because somebody has an inventory objective. And these are two of the three best sellers that he did in the 1970s. The other one was making it in the market. Now listen to this quote from him. This is beautiful. In which it is shown that if you scrap traditional approaches to the market and attack the financial conspiracy with its own weapons, you can beat the stock exchange insiders at their own game. And you've seen that on chart after chart after chart that I've shown you. They can't hide their footprints if you know how to read them. Lucky Luciano, the father of organized crime, he was interviewed, and he said after a visit to the Florida New York Stock Exchange, a terrible thing happened. I realized I had joined the wrong mob. Organized crime is peanuts compared to what they take out of Fraud Street and out of your municipal funds. I should say mutual funds. Okay, here's the history. Daniel Drew was one of the robber barons, and he said anybody who plays the stock market not as an insider is like a man buying cows in the moonlight. Richard Wyckoff, and one of the bonuses in the course is his Day Trader's Bible. Listen to what the market is saying about others. What they're saying about the pros, not what others are saying about the market. And they said, like exchange insiders, you must only buy on declining prices. Amateurs won't do that. So you can create the wealth and freedom and lifestyle you deserve, and I can help you if you let me. So who am I? Hey, I started watching him on the television. UHF. For those of you who didn't know, there were two, VHF and UHF, and one had a 10 on the roof and the other had a round one on the back of the TV. And in 1989, I began taking his NA report and doing the daily updates, and I learned to trade in the trenches. You know, we didn't have all this stuff that you guys, nobody was computer trading. Nobody had platforms except for the real money on Wall Street, the insurance companies, the pension funds, but not the average guy. And you didn't get live data unless you subscribed to something like a Quotrex, which is like a smartphone. Anyway, and I got daily graphs, and I came home on the weekends and I drew lines on the charts. And that's how I learned to read charts. Again, I learned in the trenches. I didn't have everything that you had. I wish I had what you guys had. I wouldn't have had to spend the thousands of hours figuring this out. I didn't have somebody like me. I would have loved to have somebody like me and paid them and got it over with in a short period of time. Like Mark, who in 4 days watching the videos comes out, instead of struggling for $500 a month, is able in the first 3 trades to make $4,130. So I mentored S&P day traders in the live market for those 7-8 years at $5,000 a pop. So I tell you the truth, that you trade on facts, and that enables you to succeed. So here is some emails I got here. One person back here in 2014, so that's a year later. Can't believe the support and all his dealings. He's never seen it. It's unparalleled. Here's another one. I have received this. I'm enjoying the videos and other material. Easy to follow along with and very well done. And here's a guy, 12 trades. He had 10 winners out of 12 trades. He says, I'm in the process of opening TradeStation account to trade futures. Yeah. This guy just started the course. So this is powerful information you can apply immediately. Why? Because it's how those who take the most out of the market position themselves. This enables you to protect your investment, create new money, grow long-term wealth. Price and volume works in any market, any time frame. We're almost in the live market. Hold on. Okay, this is why you want to avoid these crashes that are manufactured here. Yeah? If a 64-year-old listening to experts and owning mutual funds had $2,000 in his pension in contributions and growth, in 2001 we had the crash. The crash, the dot bubble crash, manufactured. You could read it on price and volume. It told you to get out of the market. 80%, you got 200,000. In 2003 to 2004, 8, it doubled. So you had 400,000. But in 2008, the market crashed again. 50%, you're back at your 200,000. But if you avoided every crash, you got out with at least 85% and more, like 95%. But let's not be exaggeration. Let's be conservative. Under promise and over deliver. You only lost 150, you had 850. That doubled to $1.7 million. You lost 255 again with 85%. You got out. That was $1,445,000 versus 200,000. And here from 3109 of a low, the S&P, and this was a while ago, before 6914. Now we've been up to 2114 since then. So the slide was made there. So how to exit or equal plus or minus 2% for the top. I have a product that is sold for $97 called the Crash Indicator. And truly, you can avoid every future market crash by spending 5 seconds a day. And for those of you that through this webinar, because of my relationship with Brian, decide to enroll in the course, I'm going to give you this free with the course. So let's go to the live market now. Okay, so here we had the okay, I gotta do this a little different. Hold on, I'll get it right. All right. Okay, so here was your $50 stop. Okay, when did this move start? Oh, come on, TradeStation. Let's go. Okay, here's where you were tipped off that prices were going to come down. Up bar closing off its high in an overbought situation with divergence. It's the top of the market. Price came down. Okay, I won't get in through all of this here. Let's get into time where I was awake here. And what happened? We came up here. This trender's a logical place of resistance or support. And the trender told you, price and volume told you here. The trender told you a little bit later. And every time we came up to the trender here, it got pushed down. Well, here was a very weak bar. Look, it took out these highs here to get people long, just enough to get them long, and then smashed them down right away. On the 5-minute bar, they're already in a losing trade. So we have up bar of weakness, and a logical place of resistance, and that's how you knew on this Forex chart to get into the trade that first made $510. And ultimately down here made $1,300. Okay, so let's get out of there. Move over here. What do we got going here? We got here. Here is your bottom. And look at your volume divergence. As price went down, volume was diverging. That's a sign of strength. Here we got one of those down bars closing up off the low, above the middle of the bar, on increasing volume. Pros had to be buying here, and the market is oversold. Then look here, divergence. If this was strong, how come this bar went up here and came down and closed here? Then we got 2 bars of weakness here. From an overbought situation, price came down. It's that straightforward. It's that simple. It's not that difficult. What I got here? Okay, this is obviously a Forex chart. We don't need to know what it is. It doesn't matter. Look at the pattern. Here, same exact pattern. All you had to do is buy in here. Here. Perfect, perfect, perfect. All the way up. Doesn't matter. Any market, any time frame. We don't care. There. Let's go to the day trend here. Here's oil. Oil trades 1,000 barrels. 1,000 gallons in a barrel. So each dollar move from here to here is $5,000. At $1,000 per dollar that oil trades at. Well, here you had 3 bars of weakness with the CCI divergent. So the background here is saying to anticipate lower prices. See? Resistance. They couldn't get through here. This was telling you. The market is weak. Momentum is declining and prices can't get higher. And this is a bar of weakness right here. So, we want to sell up bars of weakness where the market's overbought. Here is 7 shots. This one, I can't get in here to change it to yellow. There are 7 shots. Look at this trend that started last July. 7 shots. We went from about 100 to, at one point, oil came down here to $45 a barrel. That's $55 drop. That's a $55,000 move. What if you traded that on 10,000 margin? That'd be over 5 times your money. Serious money is available if you know how to find it. And it's there all day, every day. Okay, so let's go over here. Here we go. Here's the ES, and this is on a daily chart. And I'm going to blow your minds now with what I'm going to show you. Here. This is a more sophisticated chart, only because I know price and volume, so I know where the trade should line up. So I had indicators created that would help me to identify them. No ifs, ands, or buts about it. So we see the strength over here. We come up. We want to buy on a down bar of strength at logical support. Momentum's moving up. Red down here. This tells me a place to buy. I told you, I'm going to blow your mind. Because look at the date here. This is the 9th of February. The S&P told you to buy. The S&P right here told you to sell. Right here. This is the day that the NASDAQ made its all-time high after 15 years. And CNBC is saying, buy, buy, buy. Well, price and volume told you, if you want to keep your money and make some money, you better sell. And right here, momentum's coming down, blue, and cayenne on a bar of weakness when the market was over bought and on divergence, and you sold the top of the market. So let me go over here, and maybe you guys know about the bullish percent index, and maybe you don't. If you're a position trader, you need to know about this because it's in many different markets. And hold on, I'm going to take my shirt off. It's getting warm in here. Okay, I'm ready to sit back down again. All right, so here is the bullish percent index, and right here at the beginning of February, that told you to buy the market. Look at the divergence here. Price is lower, but this RSI is higher. And this is standard. You can get this at stockcharts.com. You can buy right here. Look what happened over here. This was before March. It was giving you a sell signal. It had peaked out here, overbought, and came back under the 70. Look what the bullish percent index did. So, again, now let's go back to that chart. It says it blows your mind. If it doesn't blow your mind, I don't know what will get you off. Bullish percent index on the 9th here, S&P said buy, and on the 2nd of March here, the S&P said sell. It's not that difficult when you know how to do it. There's a lot of money to be made. And you can see the money that's made. You know, this is $50 a point. And so, you bought here, we'll say it, $20.45, and you sold here at, we'll say $21.15. So that's 70 points. That's $3,550. It was when I sold here at $21.15. Again, I'm making the math easy. And this is right back here at the 45 again. So that's $7,000 between the 9th of February and now a position trading the S&P. And the signals are as clear can be. If you can read them. Okay, so let's go to the live S&P chart and see what we can find going on today. Okay, I told you I'd show you how, and this is worth the price of admission. You will never be a breakout trader again. Unless you want to self-sabotage yourself, unless you want to piss your money away, then go ahead and keep doing what you're going to do. Remember, I ask you, are you willing to do something different to have a different result? It's your choice. You make that choice. So here, they went below here, and what happened? They got people short here and took it up. They went below here, got people short and took it up. They broke out over here and got people long and took it short. They broke down here, under here, and got people short and rallied the market. They broke out over here and dropped the market. You see a pattern? You see why you don't take breakout trades? Here. They went below it, brought you back up here. Over and over, and I stopped counting after 8. But there it is for you in black and white or living color if you grew up in black and white television. Okay, so let's look at the chart today. And this is not a pleasant chart. This is a day of consolidation. And hey, kids, I didn't have any way of knowing this at the time that we set up the webinar, that we'd have a day of chop. But this is a real choppy day. So it's not the most pleasant thing to trade. But nonetheless, these are two different trenders at two different time frames, a longer time frame and a shorter time frame. And I'm going to take the trenders off of here and get back to just price and volume here. And let's put on daily pivots here. These are not daily pivots. They are actually floor trader numbers. And consequently, you've been lied to. In the old days in the trenches, we had to take these things and we had to calculate them by hand. It's done by high-low close, divide by 3 times 2, subtract this, add that, and it gets you fair value, which this is, and then it gives you resistance and support 1, 2, and 3, which, because of yesterday's drop here, they are spread apart so far that we can't see them because we haven't reached there. So what happened here? Look at there once again. They took amateurs long above here, right there, only to smash them down. Now, where did price find resistance? It found resistance at a floor trader number, not a pivot point. Don't let these bastards lie to you. They just don't tell you the truth. Pivot points are different. Here's a pivot point, here's a pivot point, here's a pivot point, here's a pivot point, pivot point. That's how we learn trend. You want to learn trend? You want to know to buy? Here's a bottom. Here's a top. Here's a bottom above a bottom. Maybe an uptrend. Oh, here's a bar of strength, a test bar. A test bar of strength on price and volume. And, oh, imagine this. It's oversold. So once again, we applied our rules. Here at the bottom, this is an order flow. These things were drawn months ago when we were at these prices. They weren't drawn yesterday. Money never forgets. And in the course, you're taught how to deal with order flow lines. It's an art and a science, as I told you, but these were all drawn a long time ago when price was here way back when. Remember, we just came down from 21.14. So price, back when, if we go put up an S&P chart, yeah, and this is a daily chart, so it's a little different, but yeah, we were at these prices that we're at now way back over here. So these lines didn't get drawn yesterday. They got drawn because of stuff that happened over here, and they might have been drawn back over here. I don't know, and I don't care. But I never take them off of the chart, and I just haven't been putting the daily ones on here. But here again is your sell signal, and here we came down, up bar, logical place of resistance with a dot, closing off its high. You could have reading price and volume. I told you could have sold here. But if you didn't sell there, you could have sold on this bar here. Hell of a lot better to get out of 2100 than 2046 and been involved in this down move and that down move. Price and volume told you what to do. Even the trenders switched over right here to get you out at the high. Again, moving average didn't do that for you. Okay, so back to here. What we got here? All right, so here we found strength. And look at the divergence here. We found the strength, came up, had a bar of strength, oversold. We want to buy. Found logical support at the moving average. Well, what kind of stop? I told you you'd be able to trade with a $75 stop. So opened it 2042. The low was 2041.75. There's nothing up my sleeve, guys and girls. This is the truth. It's happening in real time like this because I've told you the truth. So, again, you could have bought this. Yeah, would you have been filled in a market order at 42? Hell no. Unless you got lucky. If the ask was there and the bid was 175, great. But it probably wasn't. It was 2 by 2 1/4, so you got filled at 2 1/4. It went a whole $25 against you, so your $75 stop worked. Let's just say we got filled at 42, so the math is easy. We ran right up here to 47.50 at the highs here. So that was over. We'll just make that 5 points. So that's $250 on the 4,000 margin. Oh, look where price first had resistance. At another order flow number. Oh, we didn't get in here. Well, here we got a down bar, logical support. Again, strength here. Oh, is the market overbought there? You're damn straight it is. Oh, a down bar. We want to buy on a down bar strength that's oversold at logical support. That's the rule. That's it. Nothing more. Okay, let's see what stop worked here. Okay. Open at 43.75. The low is 43.25. As Perry Mason would say, I rest my case. What can I tell you? This is the way that price and volume works. Here's a buy of weakness. Overbought. Closed well off its high. I would expect to see increasing volume. I did see increasing volume. Pros were selling up here. It doesn't look like they took this out here, but I got right here. And where did it happen? At this order flow line that was drawn at least a month ago, and maybe more. And now we're in congestion and going sideways here. And it really takes an advanced person to be able to read what's going on here. But being able to sell here, and here's your second wave, here's your logical place of resistance, here's 2 bars of weakness. I bet you that there's divergence between this bar and that bar, and oh, what a coinky-dink. Price here was just a tick higher than that. Could have been level, but look at how momentum is falling here. And we're already telling you, if you know how to read CCI, this longer term CCI is telling you you're in a downtrend. But this bar here told you to expect lower prices. And this bar here told you to expect higher prices. And this bar told you to expect lower prices. And this bar told you to expect lower prices. So that's straightforward when you know how to read a chart. Okay, so what else can I show you here? Let's see if there's anything in Forex that's telling us. Here, top, bottom, top, bottom. Okay, this top took out that top here, but this bottom took out that bottom. This top is below that top, bottom, top, below top, bottom, top. And that's how we learned to tell trend in the old days in the trenches. Bottom, top, bottom, top. These are true pivots, not those floor trader numbers that they tell you are pivots. These are true pivots. So this was a little not exactly trending wonderfully, but wasn't that difficult to figure things out. And we talked about this coming up here to a logical place of resistance, weakness, divergence. And hell, this here, what do we do? Okay, opened at 806 and the high was 819. So less than a 2 pip stop work there. So we'll say that we went at 800 because that 6 is a partial pip. 800, and we came down here to 41. So that's 39 pips. This is $390 right here. Okay. I think we made our point. We've seen it in the live market here. We've seen it on daily charts. We've seen it Forex. We've seen it the S&P. We've seen it every which way that you want to. If I go here and I show you a Dow chart, Dow chart's going to do the same thing as to when you wanted to sell the market. Here, look at the divergence here. Look, they took out here to get people long. This is why you don't break out. They did it. Bam. Off to the races. The trender here. You could have sold this day right here at Logical. You could have sold here. You could have sold there. You probably couldn't sell there, as most people can't read the bars that well. But here and here, yeah, you could definitely have sold there. So the Dow was telling you, and I showed you over here, wherever it might be. I showed you here how the bullish percentage index told you to buy here and to get ready to sell here. There's not much more I can do if you're not convinced at this point about the effectiveness of price and volume and how well price and volume work. There's a picture of me in case you wanted to see me here. This is the members area, and I was telling you that the crash indicator is in here, and then you have your course with actually 14 videos Then you got some bonuses here. Think and Grow Rich by Napoleon Hill. The Day Trader's Bible I told you about. Here's the definitive guide of price and volume that I wrote. And I'm going to bring up Jan Arps here momentarily. Jan is 80 years old. He's one of the original coders. Got involved in the early 90s when we were able to start using computers in normal life, not being an institution that's got 10 million or a million to buy the programs here. Jan was trained by Wells Wilder, who many of the financial indicators that are in every trading platform were used by, or developed, by Wells. And Brian was on the phone when I was introducing him to Jan, and it was the day after Jan read this, and Brian can testify. Here, Jan has been coding, and he's won awards, and he's a definitive coder on the planet today. And after he read this, I asked him what his opinion was, and Brian heard him say it. He said it was fabulous. It was something that he would treasure. And this is done in 16 pages. 8 pages of me describing price and volume, and 8 pages of NAY quotes teaching you about price and volume. And the NAY report comes with it here. And the NAY report, that report you get will show you that war is good for business, and why I knew in 2003, this was from 1990, and they said in the report that when we go to war in Kuwait, back up the truck, get all your money and put it in the market because the market's going to rally, and it did. So after seeing that, when we went to war in 2003, I knew, get your money in the market, and I showed you, money doubled in the market, and that's just the averages. If you bought things that were better or you traded the futures with leverage, you kicked industrial butt here. So that's the NAY report, which is different from the NAY guide, which again, I hope you guys read to prepare yourself here. Okay, let's get back to slides here. All right, so you can do this. You can take control of your financial future. You can change your relationship with money if you want to. It's a decision. Why price and volume? Pattern recognition. Because all the major trading fortunes have been made by taking advantage of the smart money. The larcenist. Prices don't move. They are moved for inventory reasons. It's the line of least resistance. Pattern recognition trading is following the footprints of the pros. And it's simple. I just showed you how simple it was. Here, this guy said got 48 pages on volume alone. In 8 pages, I'm talking price and volume and everything you ever need to know about it. All you need is a price and volume chart, and that will dramatically improve your trading results, and it'll transform your life. Okay? We'll get that. Okay, so the time is now. It worked 150 years ago, and it's going to work 150 years from now. Only you can take control of your life and create the wealth you deserve. Nobody cares about or will care about your money better than you. So if you don't do this now, when are you going to do it? And procrastination has its cost. When you know how to read a chart, the trades will find you. Can you dig that? How cool is that? The trades just jump off the screen for you. You don't have to go looking for them. You can change your relationship with money. You can make it, you can protect it, and you can grow it. So here's what you get if you decide to work with me. And that's back in here. All these modules that you see here. So how the market works from the inside, how to develop a professional trader's mindset, 19 essential trading concepts that lead to success. Then we're going to get into the secrets of pattern recognition for duplicating professional results, and that's the NAY stuff. There's 8 other drawings in there besides the one that I showed you, only I brought them up to modern times as opposed to NAY only having a IBM Selectric and a typewriter ribbon. I had a computer change them so they look really nice for you. And then you learn what to trade and identify the best trading instruments. And hey, you got a stable full of horses, but when the market's going to buy or sell off, there's only so many of the horses that are ready to run at that particular race. Then you're going to learn how to place your stops and protect your profit targets and those order flow levels that I showed you about. And then I know people can only spend 30 to 40 minutes with their attention, and then they start losing it. So I had to do some of these in 2 parts, and how to read a chart in 2 parts, the trading process in 2 parts, gold in 2 parts. Gold's a lovely market here. Yeah, we can go back and if I can find it here, and day trend. Yeah, we can look at the gold market here, and yep, here. Oh, orange bar, orange test bar of weakness at the top of the market. Again, I can't make this up. It's the way that it is. And, gold is sold, and the big gold here is $100 a point. So we've gone from 1,300, it's 140 times. There's a $14,000 move here, and it's still going down. And I think you could have sold here, and I think you could have sold here. No question in my mind about it. So any market, any time frame, doesn't matter. So how to exploit the power of compound interest. And again, Einstein said it was the most powerful force that man's created. So you're going to get Best Trading Strategies Quick Start Guide, and that's this video, the introduction, and that's how to benefit most. And it's going to ensure that you stay on track to rapid growth, and the checklist format, it more than levels the playing field for you. And I actually already gave you the rules. So here's the definitive guide, as I talked about, and it's only 16 pages. It's simple, it's straightforward, just the facts, as Joe Friday used to say on Dragnet. So, and then you got your Abundant Success Library, and the Think and Grow Rich. More people have read this and changed their mindset and their emotional set to become rich. Andrew Carnegie commissioned Napoleon Hill to write it. Here's the Day Trader's Bible by Wyckoff, and here's the Ney Report from August 1990. Then as bonus, those 4 recorded webinars. This is for the first month of membership. I did them live, and the last 2 I really elaborated on the definitive guide, what I'm seeing between the lines. And for the first month, you get a daily and sometimes several emails. It's a trial. If you like it after the first month, it's $97 a month thereafter. And you're going to know exactly what the professionals do. The only thing that changes are the alibis. Nothing else. The disguises. It's always the same. So, here's my new relationship with Jan. I told you I'd talk to you about him. And he is working with me. I've given my code. And he's using what he knows and what I know. He's gone through the course. He's viewing the course videos. And he and I are creating a package of indicators that he's a coder and I'm not. And it's going to eventually put up a dot or something on your screen when the conditions are met for trades to be taken. It's not developed yet, and they said he's a winner of awards, and he's been around longer than anybody else alive as far as I'm concerned and actually know. So that's something in the future here. And here's the cost of procrastination. And this is a simple $10,000. If you waited 2 years to put it up and put it to work for 25 years at 10% a year, and I showed you a way to make 50% a month, and compound it even more than that, but at 50% a month, 10,000, and it would, without compounding, would grow to 60,000. But here, if you put 500 a month in at 10% over 25 years, it would cost you, for waiting 2 years, $118,000. If you wait 5 years on 50 grand and you put 2,000 away, it's going to cost you over $1 million. So the only way price and volume can fail is if you fail to use it. Once you understand how professionals manipulate prices, you'll be able to recognize their patterns, you duplicate their actions, and you're going to achieve extraordinary results. The principles can be used again, any market, stocks, commodities, futures, ETFs, forex, options, doesn't matter, and in any time frame. It's universal. So, the investment in yourself. This is $997. This is a gift. If you went to Harvard to get an MBA, it would take you 6 years and you'd spend $350,000. Well, that guy Mark spent $997 with me. He spent more because he bought indicators and he subscribed to the email. But you saw in days he made $4,100. So if you believe that you're worth the investment, make it. If you don't believe you're worth it, don't make it. If you want to become the unlimited success you deserve, you make it. So you can take advantage of this opportunity now to learn to trade with the market makers. And this is an unconditional 30-day money-back guarantee. I'm taking all the risk. I'm so certain that you're going to find this of value that you're not going to exercise the money-back guarantee. So this is risk-free to you. So the benefits of membership: once you understand how the professionals manipulate the prices, you can recognize their patterns, duplicate their actions, and achieve the same extraordinary results. And you've seen extraordinary results, and they ain't made up. It doesn't matter whether you're totally new to trading or if you've been trading for years. Best Trading Strategies Revealed will help you quickly develop your trading skills. And obviously it's worthwhile to create those skills. So you're learning a sound, simple, proven method for making trading profitable and low risk, tightest stops, that you can quickly grasp. You not only gain the know-how, but the confidence to trade like a pro. And the principles, again, any market. So this is practical, hands-on training that you can apply immediately, and we saw someone who did. So the promise: if you take the time to use the program as instructed, your life will change dramatically. Again, the only way this training fails is if you fail to use it. Period. Unequivocal. So, again, a low investment of only $997. And remember, I used to teach day traders for $5,000, and that was 7 years ago. It's very simple. If you're a position trader, you're only going to need about 30 minutes a week to look at your charts at the close. If you're a day trader, it's another story. But you go and you pick up, you make yourself charts like this day trend, where you got a bunch of things in here. Here I got bonds, I got the dollar. Here, hey, look at the dollar here. You want the trend started here. All of these are buying opportunities on the dollar. This trend started last July. Every one of these arrows you could have bought in that and made money. And following the principles here. So the money's there. Are you worth the investment? That's your choice. You got to make that decision here. So you have a choice. You can be part of the many or one of the few.